Hey, welcome back, everybody, to today's Market Explained, a FourStar podcast and media experience. I'm your host, Brian Kasal, and I'm here with my longtime trusty co-host, Mr. Christopher Reardon. Chris, welcome to the podcast.
Thanks, Brian. Good afternoon, everyone, and glad to be here and glad to talk a little bit about these crazy markets going on.
And crazy it is, Chris. Every week it's something new, and part of that has to do with that we're in this strange environment where the American President Trump's trying to change the world and reset the balance a little bit. We've got tariffs going through. We're not sure the impact. Earnings are unsure. We're in a news-driven market, so trying to make sense of it is a little more difficult. But Chris, what does it look like right now? We've got all the asset classes shifting around, don't we?
Yeah, I mean, we certainly have some movement with the asset classes. Domestic equities, though, is the one stalwart really at the top, so it's holding pat. Equal since the last podcast, and it's still at 241 tally points or buy signals. But interestingly, in the number 2 and 3 position, we now have a tie. International equities has gained 6 points to move to 239 tally points, which came in lockstep with commodities, which gained 1 point to be at 239 as well. So we kind of have a tie for the number 2 position. And really interestingly, I mean, those are only 2 points outside of domestic equities, which is in the number 1. So we really have just a uh, closing of that gap there, I would say, for those three. So, I mean, realistically, we could see any asset class be the number 1 almost any day now. I mean, it's just a slight movement here or there, and we could see any of these swaps. So, and some of them will obviously keep a close eye on. Make sure we're tracking. Cash is still in the fourth though position,
Okay.
now -4 from the last podcast. Currencies is in fifth, -1 from the last podcast at 124, and fixed income is in last, equal and at 103. So, once you get outside those top three, there is a big gap there, and really becomes a non-factor, I would say. But those top three asset classes, which are all the kind of risk-on asset classes, it's definitely interesting. We're definitely seeing some movement there. And it'll be interesting to see kind of if these trends continue. Do we have international take over that number 1 position? Does commodities kind of resurge back up? We'll just have to kind of wait and see.
We will. Well, it's interesting though, Chris, the top three asset classes, while domestic is number one, commodities international tied for number two, they're both within a nose hair of each other, really. I mean, right now, they're all together growing at an equal basis, but the movement is all in commodities and international. Commodities are up big, international is up big up to our last episode. It's up big again relative to the others this time. So, we're going to talk a little bit about a very interesting scenario from the past in which commodities and international dominated performance in US dollars. But domestic equities have had such a run. Maybe it's time for them to slow down a little bit and other leaders to take the fore.
Mm-hmm. Well, I mean, we've certainly seen, I mean, we have a lot of currency movement now. So, with that, you do see commodities move heavily. I mean, we've seen the massive runs in gold, precious metals, things like that, as well as the fluctuations in oil. So we definitely see a little more volatility ripple, which what does that do? That
Yeah.
creates opportunity. And international equities, although, we have these trade tariffs and things going on, some of the news from some international markets, particularly the EU, which we talked about last time, lowering their rate. Their inflation seems to be a little bit more in check. Things like that. It could be just time for a little bit of more of a run there with the international markets than the US. We'll see though.
Yeah. Well, we'll see how it goes. So as of now, the S&P is up 2.37% for the year. So we were up about 10% in January, went down about 15%. Now we rallied all the way off the bottom. So we're up a couple percent. The small caps, which are way down, have rallied all the way back to flat. They're up less than 1%, 0.77%. The NASDAQ technology was also down double digit after being up double digit earlier in the year, back to about 1.17% positive. And then the Dow Jones, which was lagging a little bit too, they're basically flat now at 0.62% positive. So all the markets are slightly positive, but for all the movement, all the drama, we're still kind of back to square one right now as of June 10th, as we do this episode taping today, Chris.
Yeah, we it's been interesting. We've really seen kind of a almost a full circle where you had some sectors, especially that kind of took off beginning of the year, but then had huge collapses, mostly technology. But some of those have kind of come full circle. You've had other ones like utilities that are more just having been, exploding off. But there's just been more steady movers that have been gaining. So, it's been really this almost, as you said, full circle where we had technology kind of come out really hot, kind of pull back heavily, at one point down 20% plus, and coming all the way back up now, to kind of be positive again. So
Yeah.
really interesting market so far.
So it's a pretty wide divergence, though, between different groups, right, Chris? So let's look at the best sectors for the year and the best three and worst three.
Yeah,
Um,
so I mean the best sector so far this year has been uh industrials up 7.72%. So I mean, and that's really interesting. And I think that highlights to kind of what we were talking about in the beginning, which was um, these kind of steady movers are really right there. Outside of that, you have communication services, which that kind of is an interesting mixture, and it does include some of the tech companies, but it also has in there, companies that are less tech. So you have like the Comcasts, kind of the more utility play on tech, right? And then the third best year to date, all these numbers are year to date, is utilities. So that's really interesting, up 7.26%. So you have this big gap there. And then, when you shift over to what's been kind of the, underperformers, as you mentioned, Brian, for the year, the biggest one is consumer discretionary, and that's down 4.32%. So that's been kind of the biggest laggard year to date. Outside of that, healthcare is down 1.14%. And that's a really interesting one because healthcare, if you look just at like Q1, was one of the kind of the leaders. It was one of the ones that was holding up better. But we have seen a bit of a sell-off there, and it just hasn't gained back quite as much. And then energy is the kind of the last, I would say that's kind of negative still year to date, and that's down to 84 basis points or 0.84%. So, really interesting movements there. The one I will highlight though is the tech or info and technology sector. So that at one point was down almost 24% and has now recovered all the way back to being up 1.37%. So we've seen kind of a real big full circle move there with info technology. But as I said, it's been, I think kind of the non-flashy names, the industrials, it's been the utilities, the communications, you can argue, but I do think just with that mixture has really helped it. It's been those names that I think have really held the best value so far year to date.
mhm. And financials are right behind those top three as well, I believe. And those those have been laggards for a long time, but now with interest rates rising, the banks getting stronger, the banks are strong. A lot of bank stocks are rallying here, and
Yep. Now financials are up about 5% to give you guys
yeah.
perspective. So, it is right there. Certainly, and those have done better as well. And I mean, there is some volatility within those, obviously. I mean, when you're talking about interest rate moves and all the stuff going on there, but I think
Yeah.
those have still held pretty well.
Well, and obviously, we put all this together, all these groups into an average. So the average is up 2.3% for the year as of today. But it's a bunch of groups up 7%, and then a bunch are underwater. So that's always the way it is, right? So the Dow Jones or the S&P, these are just averages. And so what we try to do is to find the areas of strength and avoid the areas of weakness. So we would want to be out of healthcare and consumer discretionary and energy and in utilities and communication stocks and industrial stocks. And that's a way to outperform, right? So if you're going to outperform a benchmark, you have to diverge from it. If you just index like everybody else, there's no better or worse than the index. So if you own most names in the top 3 or 4 groups and avoid the others, you should do better than the market. So there's a way to beat the market, not because you're brilliant or smart, you just follow trends.
No, exactly. I mean, and I think beyond that, those top three, even if you were just overweighting those, that's going to help you. And even just cycling out of, the sectors when they start to maybe underperform. And a key
Right.
example is, like I mentioned, healthcare at one point was a better performing sector. It has since kind of fallen off. So, if you're just kind of set it and forget it style, and you're just going to wear that down and kind of continue to eke out maybe a minus
Yeah.
1% return. Whereas if you're a little bit more active and see that sell off and kind of sell out of it and cycle into, say, communications or something like that, you're going to do a lot better.
Yes. Well, and then I took a look at some of the internals of the markets, like what looks good here, what's breaking out, what they're technically calling buy signals. And these aren't recommendations, everybody, but I'm just going to give you some names that look like they're acting better. Whether you buy them or not is really a decision you would make. But Amazon, Oracle, Google, these are all names that were broken that are starting to break out now. Um, Add to that, Nvidia, which was totally broken for a number of months, has come back up. And then we've seen gold rallying for a while now. Gold setting new highs. Silver is finally breaking out. We finally just saw some real strong movement last week in silver. And then, there's groups that aren't doing as well, but there's assorted names like in healthcare. Cardinal Health is one that broke out. Um, LabCorp, Laboratory Corp. So there still are in certain groups overall that aren't doing well. There's individual names. So we track all this on various systems that we have, and that's how we try to find, how do we beat markets and how do we get good returns. So that's just a flavor for what's going on. So, things change. Just when you thought you figured it out, it all changes. That's how the markets are. So you have to always be watching very closely. And we meet every Monday and review all the portfolios, but we're getting signals literally every day on this change and that change, and a whole sea change in this group and that group. And so that's you have to be that involved to be successful, we think, over time in the markets. Um, so Chris, you have more on the markets as well.
Yeah, so switching over to kind of some the economic data, if you will, especially
Yeah.
with the US. A couple interesting things came out, especially from the jobs sector. But the first one I'll highlight is some ISM manufacturing PMI. So we got that number for May that came in at 48.5, which was below estimates, which were 49.5. So anything below 50 is contraction. So the manufacturing purchasing managers index, we're kind of seeing it as far as manufacturing contract slightly. And then when you switch over to services, that fell to 49.9 in May, which was well below expectations. We're 52.1. So that's interesting. So that marks kind of the first contraction, just below that 50 mark number there that we've seen so far this year. So we're starting to see some of those roll over. Some of it
Mhm.
could be due to tariffs, things like that. We don't know, but we're starting to see that ripple through for sure. April factory orders came in at minus 3.7%, and that was below estimates. The estimates were actually minus 3.1%. So, obviously that's not good. That is definitely an impact of the tariffs. And what we saw, if you guys recall, the March number was 4.3% as people were trying to kind of front run the tariffs. That was actually revised down now to 3.4% as more data came in. So, as far as the factory orders, things like that, definitely not the best picture we're seeing there, but we are seeing those tariffs. And we talked about this. We definitely knew this was coming. So as much as this could be a surprise as far as, below estimates, things like that, as far as it being a negative 3.7 or 3 number, not too much of a surprise there. We knew that there was going to be an impact of these tariffs. This is certainly a byproduct of that. Switching over to kind of the housing market. So the MBA 30-year mortgage rate, the average mortgage rate last week was at 6.92%. That was actually down slightly from the week prior. That was 6.98%, but still, I mean, we have mortgage rates for 30-year fixed mortgages sitting at about 7%. So It's going to be really interesting to see how that plays out with the housing
Mhm.
market. We really haven't seen much of a give there.
Mhm.
Switching over to the jobs market, initial jobless claims for the last week of May came in at 247,000. That was slightly above the estimates of 235,000. But the May non-farm payrolls came in above estimates at 139,000, which beat estimates, which were 130. And the private payrolls came in at 140,000, well above estimates of 120,000. So, kind of interesting. I mean, what picture does this really paint? Well, I think it shows we're seeing some slowdown in the jobs market, but I think people have been, I would say pleasantly surprised, but somewhat surprised with how resilient the jobs market has been. I think we haven't really seen this huge rollover in the jobs market people were anticipating yet. We have seen it kind of slowly trickling and slowly deteriorating here and there, but not a kind of a major upheaval there we haven't seen yet. The unemployment rate still is holding steady at 4.2%. And the average earnings year over year beat expectations for May coming in at 3.9%. So that was good to see as well. So,
Mhm.
overall, it seems like the tariffs are having the effect I think most people were anticipating as far as slowdown from manufacturing, factory orders, things like that. But I do think we're seeing a little bit of a surprise as far as the resilience of the U.S. jobs market so far. We are starting to see numbers that it is deteriorating slightly, but that deterioration has, I think, certainly surprised people that it's come much less quickly than anticipated.
We haven't seen job growth go negative yet, have we?
No, no, we haven't seen that yet. And once again, I think that points to the fact that I think a lot of people were kind of anticipating that, even though the estimates obviously weren't showing that. But I think if you went back to the beginning of the year, um, I think a lot of people were anticipating, a kind of a heavy slowdown, especially with interest rates. A lot of people don't highlight. I mean, interest rates are still relatively high, and a lot of people were baking in six interest rates cuts this year. So, if you kind of went out and said, "Hey, interest rate cuts." Might be now what they're projecting 1 to 2 interest rates cuts, if even at all. And the jobs market's still holding up relatively well. I think a lot of people would be very surprised by that.
Yes.
So,
Okay. Well, thanks, Chris. It looks like kind of swirling controversies about the economy. Something's positive, something's negative. Still positive overall, but kind of waning and pulling backward. With certain little shoots of excitement, with job growth being stronger than expected, and that kind of thing. So, and that's the way it always is. Everything isn't always going in one direction, right? So, but we'll see how much the services contraction is concerning. So some of those things are bringing the economy down, slowing down. So we're definitely having a slowdown. The question is, does it go negative? We did have one negative quarter, but now the projections are we're going to have a massive second quarter because of all the money flowing back into America and the investments back into America. And we've seen some estimates of north of 4% growth for this second quarter. So we'll see how that all plays out. Everyone expected a recession. We've been looking for a recession for 3 years now, Chris, and this is the recession that won't come.
no, exactly. I mean, I think a lot of people have been looking at it, have been anticipating it. And, you know, the American economy has held up, I think, a lot better. I think in some regards, consumer spending has held up better, although I think some of the initial things we've seen so far have shown it has started to lessen a little bit. But I think a lot of people have underestimated the consumer as far as spending. And, I do think there still is some pent up, want to go and spend and travel from a lot of the COVID, even though that's, now I would say in our rearview mirror, um, there still is, I think a lot of people have this kind of well, this want to get out and go and travel and see things. So I think you're seeing that kind of display. Whether that continues or not, I think remains to be seen. But I think that has been a pleasant surprise that has held the American economy up so far.
Yes. Well, and we'll see how it all plays out. So I mean, not net. We're still in a kind of a waning economy, not necessarily collapsing, but slowing down. We'll see how bad it gets. Markets reacted sharply to it, and certainly the uncertainty of the tariffs. Now the markets are back up a little bit. But ironically, we're not getting all the signals, Chris, are we, that we would get all our money back in that's designated to go into US stocks all the way back in? What are we seeing there?
Yeah, I mean, we're still at kind of tactical state, holding at tactical stage one, if you will, or um 104, if you will. So we haven't gone fully invested. We're still kind of holding back that last tranche, if you will. And so for our moderates, that means we're at 12.5% cash. And for our tactical, means it's 25% cash. And, you know, as much as the market as a whole seems to be, positive and doing well, a lot of our indicators, we like to take that market, chop it up, and not only look at the overall market, but the breadth of the market. We're looking at short term, kind of medium term, long term indicators. So we're looking at a lot of different variables on this to try to get a good read. There's no perfect way to do it. But at least with what we're seeing right now, that's really holding it back. It's been kind of the breadth of the market, as far as positive, percentage positive moving assets within the S&P 500, all global stocks, things like that. We're really seeing those still hold back a little bit. And I think we've had this kind of choppy market. Some weeks, I think it's been kind of almost 2 weeks up, 1 week back, if you will.
Mhm.
So we really haven't seen this kind of full bore, all right, let's pile in, if you will, movement in stocks yet. I would say some we have, obviously, some have really run, but as a broad market, we really haven't seen that. So,
Mhm.
we're still holding a little bit back here, I want to say. And I think, the key for us is why we're comfortable doing that is by having that overweight methodology, by, being in the communication sector, by, having these certain overweights, which, even if we're just matching, if we're matching the S&P 500, even with 12.5% cash in an account, that's, right where we need to be, and we're protecting on that downside until we get all those signals and we're comfortable that the market has, hit that bottom or has kind of fully turned, if you will, and is in that growth projection.
Yes. So still choppy U.S. markets. So that kind of brings me to another subject, Chris. So we have choppy U.S. markets, but yet commodities are moving up. They're ascending. International stocks are ascending. That's partly about currency. So our currency in the U.S. is fading a little bit because we keep announcing higher and higher levels of debt, which is why that Doge committee was important to try to actually cut some wasteful spending. They did some good, but it's kind of still there, but Elon Musk is gone, and the Doge folks are going to be there for a while, still cutting spending under his leadership. But he won't be directly there in Washington anymore. He's going back to his companies, and we heard about the big feud, of course, between them, and that seems to be solving itself because when things got rough, clearly with the L.A. riots and everything, then Musk came back essentially. So there's been a thaw between the two of them. And all weekend, that's all everyone talked about was this argument and fight on Twitter and between Trump and Musk. But now some of those tweets that were nasty from Musk toward Trump, he's deleted. He's supporting Trump on dealing with the riots in LA. I think there's riots starting today in Chicago. So we're going to see this all across the country. There's a manufactured group of people that are trying to create chaos, and they're blaming the president for creating chaos, but they're starting the chaos. So it's all about the narrative. People try to convince everyone else that there's chaos out there and it's his fault, and I caused it, but it's really his fault, or they caused it, but it's your fault. And so that's kind of what we're seeing now. We're seeing chaos, and we're seeing people blaming each other for chaos. And we'll see how that plays out politically, how that plays out economically, whether it affects the Congress's ability to get the spending bill done. The one big beautiful bill, Chris, they're calling it, right?
Mhm.
So, and we'll see how it all plays out. But back to the markets, um, international stocks are now fully invested in our model, but U.S. stocks are not. So, Chris, I look back to history when international stocks have done well, and it's been quite a while. we had a big run in international stocks in the 2002 to 2007 period. And all that meant was that if you had money in US stocks in dollar terms and international stocks in the US, and they're affected by foreign currencies and business in other countries, international stocks did better for about 5 years, which is very unusual. We haven't seen an international stock rally since 2007 of any more than a couple months, and certainly less than a year. We had a rally in 2015, and then last year we had about a 6 7 month rally where international stocks were stronger, and then that kind of faded again. But now we're seeing it again. So maybe it is time for international. So I look back in history. Yeah, what's the history of U.S. stocks being like the top performer, and then international stocks being the top performer? And back in the 1990s, out of the major six asset classes, U.S. stocks were favored as the number one asset class for 76% of the time in the 1990s. It was a kind of a growth market for America, and everything was good. And then this decade, 61% of the time, U.S. stocks have been strong. And then the last decade, the 2010s, 89% of the time, U.S. stocks were ranked number one. But that previous decade, though, the 2000s, U.S. stocks were only favored 4% of the time. So if you think about what happened then, we came into the 2000s, in year 2000, after a big technology rally, and then that market collapsed. So we went through a 2.5 year technology collapse, and that affected the U.S. market. So commodities and international did much better for that 2.5 year period of time. Then when we came out of the bottom, international stocks and commodities rallied stronger, and the U.S. stock market went through a period of time where it grew, but only at an average about 6.5%, not the normal historical average of about 10%. So international and commodities outperformed for almost 5 years. Then, after that was over, we had another big crash. In 2008, the Great Recession went through. The market was down 38% in 2008, down big in 2009 initially, and then rallied. So, international commodities were the strongest asset classes in that decade. So, Chris, is it possible now that we're going into a period of time that since we built up massive debt, our stocks have rallied so much for so long that maybe it's time for the international markets to do better, maybe time for the commodity markets to do better as well? It could be possible. We'll see.
Yeah, I mean, I think there are things that are playing into that are, you look at, especially, just, as a good point, the European markets, I think what they have going for them, I mean, is inflation seems to be more under control. And you have a lot of these, especially with what Trump has pushed, a lot of these countries that are starting to try to ramp up their defense spending. And as much as that's, government spending, it is going to help over their overall economies, and it is pouring money into it. And when you do defense spending, if you're building, say, tanks or vehicles, what are you using? A lot of metal, a lot of manufacturing. So there's
Right.
a lot that kind of gets pulled through this. And that's just, looking at, one area, one economy, if you will. So I think that there certainly is things to be said as far as the international markets and commodity markets into play with the heightened geopolitical, world climate we have right now
Mhm.
that's going on. So, we'll see. There are a lot of variables out there. I know right now a lot of eyes right now are on the Chinese US trade talks.
Mhm.
The US markets right now there's a lot of bets, if you will. There's a lot hinging on it. There's a lot of that, as far as the oil market, as you said, Brian, we've seen a rise there, but if we have a collapse in talks or something like that, it's nature-wise, you could see a bit of a pullback there. So there is still a lot of variables in play, but I do think with kind of the zeitgeist, if you will, of this current modern economy and the EU, and with the Russia-Ukraine war, everything going on, I think you're just seeing more of a buildup militarily, and things like that are happening that are really going to help drive as far as the European economies, Asia even. I know Japan's looking at, ramping up some of that. And then what's that going to do? That's going to feed a lot of, metals, industrial metals, the need for these as far as building.
Yes. Well, we'll see how that plays out. An interesting trend. The Fed has been signaling, Chris, that they're going to be even more cautious at lowering rates now. We came into this year saying it'd be 4 and 5 rate declines. Then they're saying we're going to have one in September. Now they're not sure. So it's all changed. So a lot has changed because of the tariffs and the whole situation that the government's involved in. And they're still working on trying to extend the tax cuts from 10 years ago. And if they don't pass a new spending bill, we go back to higher tax rates. And the one side of the Congress wants that to happen because they want the revenue to reduce deficits and spend more, I suspect. And then the other group wants to keep the tax cuts going and keep it. So that's this supposedly called one big beautiful bill. And so we'll see if they can get that done. The House passed their version of it, but now the Senate says it's dead on arrival because they want more spending cuts. And we have done a lot of spending cuts, but they think there should be more. We should not probably be running deficits anymore. We're getting to such an existential point that we have so much debt in America. We need to catch up to our debt. And so they're trying to find a way to run no deficits for a period of time. And that was actually the genesis of some of the feud between Trump and Musk over the last week or so. And it looks like they're trying to come back together. But there's a section in that one big beautiful bill called they call it the Trump revenge tax, Section 899, that allows Trump to retaliate on a tariff basis against countries that do not comply with the U.S. wishes. So it basically gives him carte blanche to change tariffs when he wants to. And so that was in the House version of the bill. Anyway, so we'll see if they can get all that stuff through. One thing we definitely know is the real rates on the bond market with inflation slowing down are as high as they've been in 10 years. We're seeing foreign flows into stocks. We're seeing international work. We're seeing record flows into gold funds. And as I mentioned earlier, silver is breaking out. And then if you look at defensive stocks versus growth stocks, the defensive stocks are the lowest percentage of the S&P 500 since year 2000. That's in all the growth stocks. It's technology, communications, all those groups have been moving fast and furious. So maybe there's going to be a shifting, and that shifting is what we saw in the mid 2000s. So that's why we're predicting or believing that there's going to be some sort of a shift. Whatever just went on in the last 10 years probably won't go in the next 10 years, is usually how things play out. And there's about 15 trillion now of investments that has been announced coming into America. So while there may be a slowdown in certain areas, we're seeing a speed up in other areas. So maybe we don't have such a terrible recession if we have one at all, Chris. We'll see.
Yeah, I mean, we'll see. I mean, like I said, I think people are getting a little bit more optimistic as far as if there's going to be what, quote unquote, a soft landing scenario. But a soft landing is still very hard to achieve. And so, there's a lot of, I think, a lot of things that are still up in the air right now. So,
Yeah.
we'll keep an eye on the economic data as it filters in, and I think that'll really start to paint a picture as far as is the economy holding up. And that'll, help as far as where interest rates are at. You have obviously the bill, the spending bill, the, tax cut bill, all that going through. So there's a lot of things that once we get, some more certainty to it, I think that's going to help kind of give us a little bit more of an idea of what we're going to see out there.
Well, Chris, on the international front, I think you had some numbers on that.
Yeah, so a couple kind of highlighting what we talked about a little bit. So Chinese shipments to the US sank 35% year over year in May. That's the biggest decline since February 2020 when you had the initial kickoff of COVID. So that's obviously the tariffs. We're seeing that impact kick in right there in May. So we'll be interested to see. As I said before, all eyes really are on the US-Chinese trade talks right now because that not only will have an impact for the US and China, but also just the global economy. And then switching front to the EU, German factory orders rose 0.6% in April, which really defied expectations. The expectations
Yeah.
were negative 1.76 or 7%. So, that's interesting to see, and we'll see if that momentum keeps up. I think that'll be interesting. So it does show, once again, as highlighting the EU economy seems to be in so far a better place. Whether that continues, we'll have to see. And then kind of what you highlighted on the commodities front, I'll just touch on. So oil is rising slightly, I'll say. Most of that is hopefulness on the U.S.-Chinese trade talks, and we've seen a little bit of a dip in the Saudi Arabian crude capacity supply going to China. So we're seeing that supply tighten a little bit, driving the price of oil up slightly in the short term. Silver, as you mentioned, Brian, is actually up 10.3% in June. So
Wow.
I don't know if we're seeing a little bit of kind of FOMO or fear of missing out as people, maybe fear they missed the gold rush. Are they piling into silver now? But we're definitely
Mhm.
seeing some movement there. And then in copper as well, we're seeing 5% move up in June. So industrial metals are starting to see, not as a broad base, but certain industrial metals, we're starting to see a little bit of an uptick there as well. So
Mhm.
certainly things to keep an eye on, and certainly things we're looking at, from our front.
Yes. Well, going into the segment of our show and what we see out there, Chris, you got a couple interesting things. I do
Yeah.
too. Why don't you shoot?
Yeah, so OpenAI, I mean, I think a lot of people have known them, the split with kind of Microsoft and a lot of the discussions there, but they're actually planning to add Alphabet's Google Cloud service, and they're adding this as kind of a need to increase its computing capacity, or their computing capacity. So, they're in their mind, they're diversifying their computing sources beyond just Microsoft by adding Google's cloud service as well. So interesting movement there. I know some of these talks have been going on for a while, but they just formalized it towards the end of May and just announced that. So that's really interesting. Staying on kind of the computing front, IBM is aiming to have a practical quantum computer by 2029. A lot of things get thrown around when you talk about quantum computing, but I think as we get towards that 2029, 2030, and we start to probably get at that time, realistically, quantum computers, that will change things significantly. I mean, these computers are light years faster in many cases than current computers, and can really process quickly. So that's something to certainly keep an eye on. And then the final thing, so for those of you who don't know, the company 23andMe, um, who, everyone knows, is you would kind of swab your mouth, they get your genetic material, they process it, see where your ancestry was, things like that. So they filed bankruptcy, and recently Regeneron purchased the 23andMe in bankruptcy court. So really, there's concerns there about, this kind of pharmaceutical giant buying all this genetic data of, the millions of people that did the 23andMe. So be interesting to see how that plays out, and if there's any legal fights there.
Yeah, it's interesting. A lot of DNA there, and it keeps changing as they add more and more DNA in there. My DNA is in there, so we'll see. Hopefully 23andMe is still governed by HIPAA, with the HIPAA laws to protect
True.
everybody's data, right? So
Yep, it'll be interesting.
yeah, well, we'll see. So, Chris, there's been some massive tech breaches affecting Facebook, Apple, and Google. And then we've noticed also it's even affected me personally, where we've had some hackers come and make fake emails and send them out to everybody. And so we saw a few others this week from other people. So there's a lot of technology hacking, a lot of people with a lot of energy to try to hurt people on their computers. It's really a shame. And so hopefully that something can be done about that. Certainly, as long as you have the double factor, you shouldn't get hacked. But sometimes nothing is hack proof, I think, right? But as we've seen now with Facebook, Apple, and Google, but you do the best you can and try to protect all your data. So we're seeing that. Also, I just wanted to mention a couple of interesting things. There's a section of Section 123 of one of the recent acts that allows a 15% tariff across the board. So the president can put those tariffs into place. So there's been lots of legal challenges, but they found that they have this ability to do that. So they just have to cite that act. The Trade Act of 1930 also allows up to 50% tariffs. So even though there's been lots of court challenges, the president actually does have the right in legislation to do the things that he's doing. He just probably cited the wrong act, an emergency act, when he put it in. So they'll probably get that back in line. The whole idea is, though, to bring trade back in line around the world and have our trading partners treat us fairer than they have. Maybe it's not completely unfair, but certainly hasn't been as fair as it could be. We talked about how the Moody's had lowered the debt rating for the United States, and we all know that there's a lot of debt. In the last 30 years, we've added massive amounts, almost 25 trillion in debt to America's financial position. But Moody's coming out now after all the other groups downgraded in 2011. That was 14 years ago. Says a little bit more about Moody's that they waited too long, I think, to put that downgrade in. Clearly, with all the debt we've added, our credit is less worthy than it used to be, and so they need to really manage that and hopefully bring the debt down, or certainly not add more debt and grow into the debt. So that's a continuing issue. And also just on the immigration front, President Trump revoked 300,000 Chinese students' visa. We've had people apparently who've been not honoring their role as immigrants, as students, and using it as a platform to get information out of America and return it to China, which has an avowed decision that they're going to try and take over America. They're going to try and take dominance from America. So Trump revoked 300,000 visas of Chinese students and also 350,000 Venezuelans who had temporary status, where they had hearings that might take 5 and 7 years. They were able to remove their status and kind of get a hold of all the issues that were going on with the border. So they're trying to solve the issues that happened in the last administration. So a lot of changes, and that'll affect commerce as well, because less people will be working, affect the labor markets also. So while those are more political things, they do affect economics, so we do try to keep an eye on it. So Chris, I think that's all I have today.
Yep. Yeah, that's all I have as well. I mean, I think that pretty much summarizes a lot of the markets and what's going on so far for kind of early to mid June.
Yes. So to recap, we're waning a little bit. The risk, we're having a slowdown. We might have a recession. We're still not sure. Markets signal that, but then they rallied back. So we're straddling it, watching it. We're not sure whether the markets are going to continue to be strong. We're certainly not getting enough signals to get fully invested, while the international markets and commodity markets are acting a lot better. So we'll see what the next couple weeks bring, and we'll be back with another episode. I think that'll be it for us today, Chris.
Yeah, sounds about right.
Okay, everybody. Well, thanks for being with us today on Today's Market Explained. We'll be back again with another episode very shortly. We're also going to have a number of interview episodes. And then next week, our firm will be participating in our summer conference, where we bring all the advisors down to a all-inclusive resort in Mexico. We have lots of sponsors that will present. So we're going to be doing some interviews at the pool like we did last December and June. So watch for that episode, folks. We'll be in a nice, hot, sunny resort, and we're going to be interviewing some investment sponsors. So you might get some interesting ideas on investments that you can make from that next episode. So we'll look forward to taping that episode, and we'll see you very soon. FourStar for today, over and out. Thanks, everybody. Bye-bye now.